All right, let's talk about today, February 4th, 2026, because something pretty wild just happened in the global markets. It's like they literally split in two. And we're going to dive into exactly why, breaking down a financial report that explains this massive, historic shift happening in AI. And this right here, this pretty much sums up the puzzle of the day. You've got the Dow Jones, the old school bedrock companies of the economy, just soaring to a new all-time high. But then, look at the other side. The tech-heavy NASDAQ 100, it completely tanked, dropping almost 1.5%. I mean, how does that happen? It's the same market, but telling two totally different stories. So that's the big question, right? What on earth could cause such a huge split in just a single day? We're not talking about a slow drift here. This was a sudden, almost violent rotation of money. And the answer, it turns out, comes down to one really powerful idea. Okay, so the financial report we're digging into has this big theory. It's saying that what we saw today wasn't just random chaos. Nope, this is a massive, fundamental change in how investors are thinking about value, all thanks to AI. They're actually calling it the Great AI Rotation. So what's at the heart of this? The theory is all about something called inefficient waste. Think about it. We all put up with clunky, slow systems until something way better comes along and makes them look completely pointless overnight. Well, the report says that's exactly what happened today. An AI agent called Claude Cowork launched, and it basically automates a ton of professional services. All of a sudden, a whole bunch of existing software just started to look like expensive, slow middlemen. And the market, it reacted instantly. And you can see the damage right here. I mean, just look at these numbers. Companies that are built on that kind of professional services software, we're talking Thomson Reuters, LegalZoom, even a giant like PayPal, they all got hammered, down around 10% across the board. It's like the market just decided their old software as a service business model is now just, well, waste compared to real AI automation. Now, that Anthropic launch, that was just the spark. The report says it basically lit a fuse on a powder keg that was already there. There were three other big things going on. First, you've got a policy shift that's pushing money towards companies with actual, real cash flow and away from speculative tech. Second, if you look at historical market cycles, we're right in a period that favors the real economy. And third, another big cycle is pointing to this huge paradigm shift, away from software you can't touch and towards physical hardware you can. Okay, so that's the theory behind what happened. But this wasn't just a U.S. story. Let's zoom out and look at the global picture. Because this great AI rotation really was a worldwide thing that split markets everywhere you looked. This table really lays it all out, doesn't it? You can see the split right there in the U.S. But check out Europe. The UK's FTSE 100 is up almost 1% thanks to merger activity, but Germany's DAX is down because of weakness in their industrial sector. And then you've got South Korea's Kospi, the absolute star of the day, surging over 1.5%. So let's drill down on Europe for a second. The report explains this split by looking at the business environment in each country. The UK showed what the report calls inclusive strength, lots of active deal-making. But Germany, it got punished for being too reliant on its old guard industrial giants, what the report calls extractive institutions. A company like Siemens, for example, dropped big time because investors are worried it just can't keep up in this new AI world. All right, now let's shift gears and look at Asia, because this is where the other side of this whole rotation story really snaps into focus. The report basically anoints South Korea as the new AI bellwether. That's the place you watch to see where the smart money is really going now. And that huge 1.57% surge really says it all. So why did it happen? Simple. As all that money was rushing out of U.S. software, it had to go somewhere. And it went straight into the companies that make the actual physical hardware that makes AI possible. We're talking about Samsung and SK Hynix, the giants of memory chips. Both of their stocks shot up over 6% today alone. And here is the why behind all that excitement. The report points to an absolutely staggering number, a projected combined profit of 200 trillion won for Samsung and SK Hynix just for this year. That kind of number is what's fueling this so-called semiconductor supercycle and turning Korea into the destination for all the cash in this great AI rotation. Okay, so we've broken down what happened today and the reasons behind it, but this report goes a step further. It actually uses its models to lay out a data-driven forecast for where things might be headed for the rest of February. And get ready for this, because This is probably the most dramatic prediction in the whole thing. The report is forecasting that the split we thought today is only going to get wider. It's projecting that by the end of this month, the KOSP will be up almost 8% from where it is now, while the Nasdaq will have dropped another 3.5%. And here's the full breakdown in a table. You can see the Dow is expected to keep climbing, targeting over 51,000. But really, the big story is Asia. Look at the KOSPI and the KOSDAQ, both expected to see some serious gains. And it looks like the Hong Kong and Chinese markets are set for a nice recovery too. The clear loser in all this? Still the Nasdaq. So with all that analysis and that forecast in mind, the report wraps up by laying out a specific strategy for how to handle this new market reality. Now, I have to be super clear here. This is not financial advice. We are simply explaining the trading framework that is proposed inside the report we're analyzing. Okay, so the strategy they lay out is called the structural pivot. And honestly, it's pretty straightforward. The report suggests betting on the winners in this new world. So the AI hardware companies like Samsung, and also defensive money-making healthcare companies like Eli Lilly. And on the flip side, it suggests betting against the losers, those older SaaS and professional services software companies that are getting disrupted. The report then gives 4 specific tactical steps. Number 1, don't buy the dip in software. They argue this isn't a temporary blip, it's a structural change. Number 2, it points to a specific pair trade, going long on Eli Lilly and short on Novo Nordisk. 3, follow the big institutional money that's flooding into Korea. And finally, number 4, hold on to the US dollar as a kind of safety net. And this quote from the end of the report just nails the whole idea. It says, what we saw today wasn't just a bad day for tech stocks. It was the market officially declaring the end of the software as a service era and the beginning of the outcome as a service era, a time where all that matters are real, tangible results. So when you boil it all down, the very definition of value in our economy might be changing right in front of us. And that leaves us with a huge question to think about. As AI gets better and better at just delivering results directly, what does value even mean anymore? For jobs, for companies, for the whole future of innovation?